This conference will now be recorded.
I'm just making conversation, Rocka, just waking you up since you hadn't read the current stuff.
Uh-huh. We did have, wait, no, I'm trying to understand it.
Don't worry about it. I told you I was trying to wake you up.
You just trying
Oh,
to get a reaction.
I'm
That's what you
awake.
do, Mr. Boyd.
Dr. Boyd, how do we have to submit the other quarters of the
Thursday,
project?
I guess by Thursday or so.
By
Okay,
what?
by Thursday. But Rodka, you already submit yours.
Huh? I know.
Okay, so let's go through our file material. And we'll start with standard costing. So you've got your building, with your business, you've made it, you begin to operate, you had some budgets in there. And so the question is, you can't just run your business, you can't just run it, just buying and selling things, hiring people, and not making sure that you're making money because you're meeting the standards that you set. So the purpose of standard costing is to go through, analyze what's going on, have performance evaluations, and have employee motivations by bonuses when they reach the target. But if they don't reach the target, then they need some corrective action so they can reach their targets. So that's what we're looking at. We have a template here that we utilize where we look at the actual of what happened and the standard. Because when you run your business, yeah, you have a standard that you set up initially. Okay. Then the actual results start to come in. And so you got to compare actual results to the standard. So we want to compare actual results, look at these variances, and then make a determination. Typically, there are two types of variances. There's a price variance. So we're dealing with ink. Was the ink bought at the appropriate price? We kind of always assume that, but in actual practice, we'd have to make sure that happened. And quantity. There was so much ink that we're supposed to be using in making the book. Were we at standard? So there's two variances, price variance and a quantity variance. And there are two different groups responsible. The price variance would be by the purchasing people. The quantity variance by the production supervisors. And so we look at both those variances and break them down in running our company, because if we're not on top of making sure that they are meeting the standard, then we could, be in for some trouble and surprises down the road. So we're going to compare actual costs to the standard of the budget, calculate variances, and when they're in, when they're major amounts, we want to identify reasons for the variances and make some conclusions and take some actions. So let's assume in making the primer, I have two departments. One purchasing, which buys everything and hires workers, and one production, which supervises the production of the book. That is, once the raw materials and the people have been hired, then they supervise the actual making of the book. So in terms of buying, if purchasing buy things at standard or under, they get a bonus. But if they are over, if they're paying more for the ink, then I want to know why. And there needs to be corrective action. Then in making the book and utilizing the ink, if the standard is 2, then I expect only 2 art cartridges to be used. So if they use less than 2 or at 2, they get a bonus. But if they're greater than 2, then they got to have a plan of corrective action. So you remember, we always bought more ink and more paper because we didn't want production to stop. But in that, so in actual practice, we're going to see and ensure that we are where we're supposed to be. So let's look at this table for an example. Suppose we're supposed to produce 20,000 books. The books were supposed, the raw materials, ink was supposed to be $10 and 2 ink cartridges. There's supposed to be 1 ream of paper at 10, and the workers were supposed to make 10 books per hour. So that was our goal, that was our budget coming out at the start of the year. When the end of the year came, they did make 20,000, but the raw materials cost us 9, so that was a good thing. It cost us less, but it took 2.25 cartridges per book. So we didn't use 2 ink cartridges, we used 2.25. With the paper cost us $6, so we paid more than standard. And the workers did a good job, and the supervisors, they only used 9/10 of a ream, so they weren't wasting paper. For labor, the people were hired at 9.5 instead of 10, so that's a good thing. And then the workers made 12 books an hour as opposed to 10, so that was a good thing. So when you're running the company, you want to compare actual to standard, and you want to motivate people when they're meeting the standard. You want to give them a bonus. But if they're over the standard, you want to plan a corrective action so that they can meet that standard. That's how you run a company. Any questions? Okay, so if we look at,
I have a question.
yes.
Okay,
What's your
so
question?
what if it's not their fault per se? For example, like what if just the price of ink just goes up and you thought it was going to cost 10, but it went to, let's just say, 15?
You can't run a company that way. You cannot run a company. Remember, you've done your budget for the working capital, and you said this is what the ink was going to cost.
Mm-hmm.
So when it costs more, then there's a problem with that. And so they have to
So you got to
go out.
redo everything.
They got to purchase on time, purchase early, check various sources, but they got to be on target at that 10. And because you based everything. Remember, this 10 was used to calculate quantity and everything else that you were making to make your break even or make your sales. Suppose we're in the 3rd year, you're supposed to be making $1 million, and 20,000 was going to do that. But that was based on these numbers. So if the actual numbers are very different, then you won't have $1 million. So that's just how business run. You can't just say things went up.
Okay, so if material did go up before your calculations, you would have to recalculate everything?
No.
If you're running
now, you can't recalculate. We made these on January 1st. This is what December 31st looks like. So the year is gone. So we go back up here for standard costing. What are we trying to do? We want to motivate employees to meet those standards. We're going to do performance evaluations, and we're going to management by exception. That is, we're going to look at people who accomplish what they're supposed to do. And then when they accomplish what they're supposed to do, we're going to give them a bonus. When they don't accomplish what they said they're supposed to do, There's a plan of corrective action, which could include firing them, okay? Which could include firing. So when the company is operating, and they got these projections, those things have to happen. But so that's a good discussion. But in terms of what's happening, if you're working for a company and your supervisor's bonus is based on those targets being met, he doesn't want to hear excuses. He want them met. Got it? So on the raw materials Inc., we're supposed to have enough. We're supposed to have 2 ink cartridges at $10 each, and our cost was supposed to be $400,000. Okay. So we did make 20,000, but they used 2.25 ink cartridges, and the price was $9. But still, the actual cost was $405. So there was an unfavorable variance of $5,000 with the ink. Okay. So even though they got it at a lower price, so you're going, why are they using 2.25 cartridges? So that's going to be, that has to be investigated. With the paper.
Question.
Yes.
So you multiplied the 2.25 by the $9 to get the 405,000?
Correct.
Okay.
That is the quantity 20,000 times 2 ink cartridges times the price 10. This is what you were supposed to spend. Well, you spent 405, so you're over. So when you run a company, the company's going to investigate that variance. With the paper, 20,000 were made. You're supposed to only use 1 ream of paper at most, and the cost is supposed to be $5. Well, you only use 9/10 of a ream, so that was good. But the paper cost you $6. So now our actual cost is 108. So we are 8,000 above our cost on the paper. So now hopefully you're getting the picture. If your variances keep going bad, you're not going to hit your goal. And you're supposed to hit that goal. Then for direct labor, 20,000 books. They're supposed to produce 10 books an hour at $10. So the amount paid for direct labor is supposed to be 20,000. Well, they actually made 12 books an hour, and they actually, we got the workers at 9.5. So our cost for labor was only 15.833, and we had a favorable variance of 4167. So the people in this area are going to say, we're doing a great job. We need a bonus, and we'll keep doing a great job. The people up here, they need to get some corrective action in place so they can be where they need to be. So what we're going to do now, we're going to further break these variances down. As we said, there's 2 departments. Purchasing is responsible for the price variance. Production is responsible for any quantity variance. So on the ink, it was 20,000 that were made at 2.25, but they got the ink cartridges at $9. And so for ink, in terms of pricing, the pricing should have been 2.25 times 10 times 2450. We actually had it at 9, 20,000 times 2.25 times 9. So purchasing had a favorable variance of 45,000, and they should be rewarded for that. Okay? So anytime, as we were saying here, column 2 exceeds column 1, the actual is less than the standard, that's a favorable variance, and vice versa. Now let's go on the quantity side. We were supposed to use 2 ink cartridges, but we were messing up some, and we used 2.25 ink cartridges. So when we multiply 20 times 2 times 10, we should have 400,000. But we had 20 times 2.25, not 2, for 450. So we had a very big 50,000 unfavorable variance on the production side. So we bought the ink low, but the people, so those people get a bonus. On the other hand, we spent, we used 2.5 as opposed to 2, so we had an unfavorable variance. So we're breaking it down. So in this case, for the people who purchasing, we don't give them a bonus, but for these people who are not holding that ink to 2, they got to get a plan of correction action because we studied it and it should only take 2 cartridges. So all the work is being sloppy. Okay? So that's where we are on the raw materials ink. And you sort of do this area item, we're just doing 3. But if you run in your company, you got to do this because you got to control costs. With the paper, we're supposed to have 20,000, make 20,000, 1 ream each at $5. So we actually used 9/10 of a ream as opposed to 1, so that was good. But the paper cost us $6 instead of $5. So paper, buying that paper and paying $1 more for $8,000 unfavorable price variance. So here, purchasing didn't do their job. What this is showing you is what $1 does. Oh, we were making 100,000. You see how that number grows? The unfavorable variance will be 5 more. So when you get it, we're just looking at small numbers, but when you're looking at large numbers, you can say 200,000 books, so it's 10, so it's 10,000. Then the variance will be 180,000. So the larger, the company is, the more they got to watch it, because the more money is at stake. On the usage side, we only use 9/10 of a ream as opposed to 1. So we had a favorable variance of 10,000. Because, we could have used a full ream. We only used 9/10 of a ream. So that was a good thing. So we have a favorable production variance. So purchasing, they got to get a plan of correct action. They got to get out there earlier, check a lot more sources. They got to buy the paper as standard.
Yes, we are passionate about who we are and what we do. We take pride in our.
Who is that making that noise there? So on production, okay, they did what they supposed to do. They really conserved paper, and so they would get a bonus. So that's what we're trying to determine as we run our company. Who's doing what they're supposed to do? Give them a variance, give them a bonus. Who's not doing what they're supposed to do? We need a plan of corrective action. Let's look at direct labor. You were supposed to have the workers pay them $10 an hour, and they're supposed to make 10 books. From the price side, the workers, we were able to hire them at 9.5. So we had a favorable price variance of 834. So they did what they're supposed to do. They got the workers paid. They hired the workers at less than the $10. Then in terms of performance, what happened? We budgeted 10 books an hour. They made 12 books an hour. So look at the major increase in terms of favorable variance. And once again, if we're talking about 200,000 book, then this number becomes 300,000. So that becomes a lot of money because of their savings to allocate for bonuses to the workers. So that's how you run a large company where you're making, 50 different products. So you got to have all of this in place so you can monitor each product. If not, you'll be out of business. So in this case, both purchasing and production gets a bonus. So your task, should you decide to accept, teams 1 through 3, you got standard costing problem 1. Team 4 through 6, you got standard costing problem 2. And 7 and above, you got standard costing problem 3. 10-point problem, not a lot of work here, but it moves you into, when you're running a company, the importance of studying actual performance with standard and having this table prepared to determine price and quantity variances. So there's always a price variance, there's always a quantity variance, and you got to control it. Any questions?
Yeah, when is this due?
Tomorrow? No, that'll be
Yes.
next week.
Really?
Can we do Thursday?
But this is only about a half an hour or so worth of work for the team.
Dr. Boyd.
Each team, listen up.
Hello.
You got the teams. You're talking about 15-minute work for each team member to do one of the variances. You got
Yes,
3
sir.
variances. You got 3 variances that relate to the ink, the paper, and the labor. So this is 10 or 15 minutes work for each person.
For an accounting major. If you don't understand this, it's going to be a little longer because you're going to have to rewatch the video, make sure I'm doing it accordingly to how you just explained it, because I'm not that visual. I have to re-listen to make sure I'm doing it right. So it's going to take a little second.
Let me tell you what the accounting major is going to do. Well,
No,
Hey.
don't tell us.
let's listen up. In actual practice, the accountant's going to make these calculations. Then they're going to come to you, management major, and say, why? What happened? Okay. So the management major is the one that got to make this work and get a bonus.
I'm not a managing major. I'm a marketing major, but I see your point.
Yeah. And in marketing, there's going to be the sales. Same thing. This is not rocket scientist work. So you got a template. We're not going to be testing on this on the file or anything like this. The goal is to give you 10 points more in the computation and relax template type deal. So we take 10 points off the final and put it on a problem like this.
Dr. Boyd,
Yes,
can it be due on Thursday though?
that'll be
Like-
due next week.
I
No,
second
like
that.
on Thursday instead of Wednesday, because tomorrow is Wednesday. So can we do it like Thursday?
I said it'll be
4:30?
due next week.
He said next week, y'all. He was just playing about the tomorrow. It was a joke.
Oh,
It's due
okay.
next week.
Making sure. Just
They're
making
so
sure.
serious, aren't they?
No, because you be
You
serious.
never know with you.
Serious.
The whole semester.
Yeah, this is
Okay.
a lot to do in one day. Ain't no way anybody was turning this in tomorrow. He know that.
Wait, Boyd.
But when you do this, you're going to find that it's not that hard, okay?
So all we have to do is just redo the. We just have to do it based off of the numbers that is in actuality.
Yep, standard actual.
That's all we have to do.
That's all you got to do, and you got the
Okay.
template.
Okay.
Now all you determine is whether somebody gets a price variance. I mean, whether they get a bonus or corrective action. That's all you do.
Okay, now I have another question. For the bonuses, do companies usually pay the difference? So like if they were $50 or 500 more or less than what it was expected, do they just pay the workers the 500 or do they just take profit from that?
They're gonna get a portion of it.
Oh, okay.
So if you're running the business, you got to motivate everybody in the business, you know, to do better than standard, so the company can do better. So each area. So the marketing departments got their budgets for sales at a certain quantity sold and at a certain price. Okay, they got that. Manufacturing overhead has this, and even administrative expenses, everything. So this is not meant to be hard, but it's something that we have to cover in the course, so you're familiar with it. For our finance majors, how many finance majors we have? I'm a finance major. Yes, Hakeem?
I'm not a finance major.
Oh, okay.
I'm a management major.
Oh, okay. So realize that they're gonna throw this at you and say, hey, take care of this. Take care of these variances. Okay. One final thing to look at. Remember that capital expenditure budget?
Yes.
So we don't just go and make capital expenditures. They're major amounts. And so capital budgeting is very important, so when you get ready to buy long-term assets, you have to study them carefully, because they're large amounts, and once you make the purchase, that's it, it's gone. So it's like a sports team which builds a new arena. You better have a lot of skyboxes so it can make money, or else you spend a lot of money. So what we do, we employ what's called capital budgeting techniques. And then we get ready to investigate a project. And there are 5 techniques out here: payback, rate of return, net present value, profitability index, income rate of return. So when we get ready to investigate a project, pick one of these methods to determine whether we're going to make the investment. And the key thing that you need to know is that the cash payback method and average rate of return do not use present values. They do not. And so they're not the methods of choice now. The last century, before a lot of focus on present values, people just work with this. They simply do it. But now you have to make your decisions based on, most times, on one of these net present values. So let's look at, suppose we're using the cash payback method. What that method says is that you got to have your cash back in so many years. So let's assume it's 5 years that you would invest in a project if the cash will come back in 5 years. We have projects A, B, and C. A brings in $275 a year for a total of $1,375,000. Average cash flow $275. B brings in nothing the first 2 years, 1,375, still an average of 275. And C brings in money only in the 5th year. So if you're using the cash payback method, since they all pay back in 5 years, project A and 4, you would accept all of these. We will go with these investments because they meet our criteria of returning our costs in 5 years. Any questions? Then we have the accounting rate of return method to evaluate these same projects. Okay, so same $1 million projects. Well, let's assume A's project life is 5, B is 8, and C is 10. And the average investment is 500,000. We get that by just saying we start off with $1 million, the 0 at the end. So divide $1 million by 2, the average investment is 500,000. The average revenues is 275, just like it was before. So we bring that 275 into this method. But then we subtract depreciation, and the average net income is even higher. And then we get average rates of return of 15, 30, and 63% based on depreciation. And so if 10% was our minimum rate of return and these projects are generating this income, then we accept all of them. So you can see if you're running a company and not paying attention to present values, which you could do in the past, then you just make decisions. As long as we got some positive money coming in, we're going to accept the project. So we accepting the project. Now let's go to a net present value focus. Same 3 projects, except we're going to take the present value of the cash flows. Once we take the present values, discounting project A generates 42,000, we'd accept it. But project B and C generate a negative amount of money, so we reject them, because if our rate of return is 10% and we could get 10% on another type of investment, then we would reject these because their net present values are negative. So when we work the problem, there's a net present value calculator online. You just put it in there, put in your original amount and your discount rate, put your cash flows in. I think I did this for the Miller one, and it throws you out a number in terms of what the net present value is for this one. And that's the same thing was done for all of these. So you just plug those in, but you see that, it's a little more sophisticated method, and it's saying, wait a minute, when these cash flows are late, no, we could have made more money doing something else.
Wait, how did they make how did you know that they made 275? Where did they get that from?
We're using that in each case.
Oh, so that's given.
Yeah, that's a given.
Okay.
So you would go through and project that, and then you put it in. Internal rate of return is another method that works for discounted cash flows, and what it does is goes kind of in a reverse way. It looks at the cash flows and see what kind of rate of return is generated and whether it exceeds the cost of capital. So here we got that 10%. So we on a rate basis as opposed to with the present value, we on dollars. So now we're just doing a little different, where we putting these cash flows in and seeing if they are going to be higher than 10% our cost of capital. We do a similar thing. We just simply get an internal rate of return calculator. We put that million in, we put the cash flows in, and we hit calculate. And it says rate of return is 11.649. and we just needed 10%. But for B and C, those rates of returns are only 8 and 6. They're not meeting our standards, so we won't use it. So once again, we see when we get the present values, they're going to be a lot more stringent on just because money is coming in. It's the timing of it. And then we have the profitability index method, which is sort of a combination of those two there, where we calculate an index. We look at our net present values plus the initial investment and divide it by the investment, and the project got to have a value of 1 or higher before we would do it. So let's look at the same situation, cost $1 million, same inflows. And if you remember, when we discounted these inflows, these were the numbers we got, okay? 42, 50, 81, 46. So to get this 1.14, we take the 42, 466, net present value, add in the million, what the investment was, and we divide by $1 million. And so we get 1.14 as a profitability index. So, you know, everybody, we have to always do things different and improve. And so they're saying that this project is 1.14. But because these are negative, they're going to reduce our, you know, this $1 million to less than that. And so the index is going to be less than 1. And so we reject those projects. So all of them are, you know, all of your net present value methods are doing the same thing. One method is just looking at the dollars and saying the dollars need to be positive. Another method, internal rate of return, is coming up with the rates that's generated by the flows and comparing those to this 10%, our stipulated cost of capital rate. And finally, the profitability index is looking at those cash values again, but they are dividing them by $1 million plus the amount of the cash value and coming up with an index around a 1. So, you know, people just feel, well, I can do it better looking at 1 rather than just blank dollars looking at these amounts in terms of accept, reject, reject. So, and you can look at the advantages of that, you know, index method. It's, you know, kind of, it's using cash flow, and it's a good way to rank projects because you can rank them based on these numbers here, which are better than just basing them on dollars only. So here we have this table now. And what I've done is I've looked at project A, B, and C, and I've shown you what the various methods do. Cash payback and the accounting rate of return, because they're simply based on dollars and not present values. They accept everything, but in today's world, you got to use one of these, a method that utilizes present values, and you're going to come up with a lot more rejections because of that. And that's what we need, because you got to pay for the money. So, you know, if you got $1 million and you borrowing at 10%, then the project needs to generate more than 10%, not just in dollars. So, teams 1 through 3, you have capital budget problem 1, where your desired rate of return is 10%. Teams 4 through 6, same information, but your desired rate of return is 15%. In team 6 and higher, same problem, but your desired rate of return is 20%. So the purpose of these problems is to get you involved in, you don't just go and make capital expenditures and spend large amounts of money. You have to have a process to do that. Any questions? Any comments? Got it all down? That sounds good to me. So I'll stop the recording at this point.